Okay, we're going to get started now. Good morning. My name is Adam Goldstein, the Chief Business Officer at the Federal Home Loan Bank of New York. We thank you for joining today's webinar presented by Clifford Rosenthal, founder of Archer and Rosenthal Consulting, and Daniel Randall, Community Investment Officer here at the Federal Home Loan Bank of New York. While the Home Loan Bank has long partnered with our members on educational programs, we've mainly done that on site, right in front of our members, but we've also done workshops and other kinds of podcasts and other events of that nature. In the remote posture, obviously, it became the norm quickly to revert to virtual meetings with our members and educational sessions. So we really ramped up the usage of webinars for all of our members, bringing together thought leaders in and out of the Federal Home Loan Bank to share insights and predictions. All of this helps your organization by maximizing the value of membership and strengthening your business. So today we will continue with that tradition. CDFIs are a growing sector at the Home Loan Bank of New York, which you'll soon see. We have created this session specifically for our CDFI members and prospective CDFI members to offer, again, insights and share unique opportunities through your membership at the Home Loan Bank. Our mission, very familiar to all of yours, is to advance housing opportunity and local community development by supporting members and serving their markets. We provide our members with access to wholesale credit assistance through different products, on and off balance sheet, housing and community lending programs, grants, a variety of other things that you'll learn about today, and really that just scratches the surface of membership. CDFIs are a critical component of fulfilling that mission for underserved communities, a growing area of concern and focus for us. We are proud to support your missions, and we value your membership and how it allows us to better act on our mission. Despite the progress we've made with CDFIs in recent years, we strive for greater collaboration between the Home Loan Bank in New York and our CDFI members and prospective members. As we continue to grow the membership, the goal is to continue to achieve greater flexibility with our regulator and policies. We hope that today's webinar will provide more insight into the history of the Home Loan Bank and the CDFI movement and what the future holds. So a couple quick notes about the webinar. If you have questions, please submit them at any time through the question box, and we will answer them at the end of the session. As always, we're looking to enhance programming for our members, so we ask that you please complete the survey following the webinar today. Of the 30 or 40 webinars we've done, an overwhelming majority of them have been at the request and behest of the membership. The areas that you want to learn about as thought leaders and centers of influence in the industry, we're able to get those folks on the line and talk to you about the most pertinent information of the day. So the topics and speakers that we select really do come directly from your feedback. There are several representatives from the Federal Home Loan Bank of New York on today's call. Obviously, Daniel Randall, Community Investment Officer, will be speaking later, in addition to Tom Citino, Director of Member Relations, Michael Beifeld, the Member Relationship Officer, which I'm sure you all know, as well as Alex Sornoza, the Member Relationship and Business Development Officer. We'll be speaking to you throughout the presentation and also answer your questions at the end. I would also like to welcome the CDFI Fund Director, Jody Harris, and her team, who I've had the pleasure to meet in person and talk to in the past. And unfortunately, we will not be able to meet in DC this year, but we look forward to getting together in the future, and maybe that will be later this year, hoping so. We also want to say hello to the parties both at the CDFI industry and the FHLBNY Partner Up, such as Neighborhood Works and Pathstone. We appreciate all these partnerships and all of you. We have members and prospective members in the banking, credit union, and mission-related entities represented from all of the regions of our district, including Puerto Rico and the U.S. Virgin Islands. So without further ado, I'd like to introduce my friend Tom Citino, who will kick off the webinar. Tom?
Thank you, Adam. Good morning, everyone. We really appreciate your attendance today, and I'm happy to be speaking with you. I'm going to talk about the home loan bank system, just a brief overview before we get into the nitty-gritty of the presentation, just so everyone kind of understands the backdrop of what the home loan bank system is and what the Home Loan Bank of New York is. So the home loan bank system was created back in 1932 in response to the Great Depression. It was to solidify and support the housing market across the nation. And also, we were a regulator at one point in time of thrifts and S&Ls. But it was formed in 1932. We have 11 home loan banks currently spread out across the nation, and we have geographic coverage. New York covers Home Loan Bank of New York, New Jersey, U.S. Virgin Islands, and Puerto Rico. But the home loan bank system's primary mission is to support housing and community development, very much in line, like Adam had mentioned, in line with the mission of CDFIs. So we do that by providing liquidity to our membership. That's our primary business. We're secured lenders, so the cooperative members would have to pledge securities and hold loan mortgages to us, and then we could grant them liquidity based on what they have pledged to us. But we also have a lot of other programs as well that would be very advantageous to CDFIs with grant programs, and they'll be covered in a little more detail by Daniel Randall as we progress. But the system is pretty big. A lot of members across the nation. As of year-end 2020, we had over 6,700 members and outstanding balances of over $415 billion in outstanding loans to our membership. Okay, and if you can just go back one. Okay, thank you, Lisa. Like I had mentioned, why would CDFIs consider joining the home loan bank system? I mean, the primary business is liquidity. So if you have assets to pledge, you could build a line with the home loan bank system. So you could have that to help you with your flexibility. It's a line that you could rely on, and borrow to fund assets should that be strategically important to you. Also, when you're a shareholder at the home loan bank, it's a high-yielding asset. Every member has to purchase capital stock, a certain level of capital stock based on their mortgage-related assets. That is a high-yielding asset historically, but past performance does not equate to future performance. However, over the course in time, and we have a slide on this, it's a very high-yielding asset, so you can get good return on that investment. We have housing and community lending programs if you're lending in lower income census tracts or to lower income individuals. Also, we have grant programs that our CDFI members have access to. We had a disaster relief program in response to COVID to help out small businesses. Members were able to acquire funding from the home loan bank and pass it along to their small businesses in the form of grants funding. So it was really very popular, and it really made a difference. We also have affordable housing and the affordable housing program, which is a grant program a competitive grant program for housing-related projects, and then also a home buyer dream program. If you're doing residential lending, that's down payment and closing cost support for lower-income families. So again, grant programs, and it could help you serve your community better. Also, the home loan bank, we do have a full array of correspondent services, wire services, and security safekeeping services available to our membership. And so that's an important component of membership as well. And then also, it gives you an opportunity to our education programs, and also to network with other CDFIs and banks and credit unions, insurance companies, and also housing associates that we have in our membership. So there's a lot of reasons why CDFI should consider membership if you're not already a member. And I just want to give you an overview over the course in time since 1995 to 2020, how advances have kind of ebb and flow through the course in time. So again, we're a collateralized lender. Our members borrow to support and build their balance sheet, to grow their real estate loans, and then also the commercial real estate loans. They can pledge those assets to us to get available liquidity. But over the course in time, members will grow their balance sheet, and generally speaking, assets amongst our membership grow more quickly than liabilities and capital. So they rely on wholesale funding, and we're a primary wholesale funding source to our members. So this slide illustrates how the home loan bank system can expand and contract rapidly. Members will borrow for strategic liquidity and also for contingent liquidity. So you see back in the year 2008, 2009, advances really peaked. got over $900 billion. These are all year-end numbers. There may have been spikes inter-year, but year-end we ended up at a little over $900 billion. At one point, it got over $1 trillion in outstanding advances. When a member borrows from the home loan bank, they're required to purchase capital stock equal to 4.5% of what they borrow. So it enables us to grow our balance sheet rapidly and still maintain a well-capitalized level. And then when the advances go away, the capital will be redeemed. So it's a really interesting business model. And as you see, 2020, we ended up at a little north of $400 billion on a system level. At one point, again, these are year-end numbers. In the first and second quarter, or April of 2020, advances got over $800 billion. So it cut in half. So again, we were able to expand rapidly and contract rapidly and still maintain the strong level of profitability. So with that, I want to turn it over to my colleague, Michael Byfeld, and he'll get more into what CDFIs have been doing with the system over the course of time. So Michael?
Thank you, Tom. Non-depository CDFI membership in the home loan bank system is growing at a healthy clip. If you look back over the course of 9 years, you'll see that CDFI membership in the home loan bank system has grown at a pace of about 7 new CDFI members per year to a current total of 64 as of the end of 2020. And over the course of the same period, CDFIs have gradually become more acquainted with our advanced products, so borrowings have also increased at a healthy clip to a current total of just under $300 million. One item of particular interest in this graph is that you'll see that in the first 5 years, CDFIs did not have a large amount of borrowings within the system, and we attribute that primarily to CDFIs being new to the home loan bank system, being unfamiliar with their processes, and the ease of borrowing. But if you look from 2016 to present, you can see a very sharp uptick in borrowings, which we believe will continue to grow as CDFIs continue to enter the home loan bank system and start to leverage their balance sheets and grow their footprint within their communities. And here is a list of the top 10 non-depository CDFI borrowers in the home loan bank system. The top 10 borrowers comprise almost $233 million of all CDFI borrowings. I'm sure you'll recognize some of the names on the list here. Capital Impact Partners is the system's top borrower, followed by Clearinghouse CDFI, and Home Loan Bank of New York's very own Community Development Trust is the system's third largest borrower. Of interest here, you don't really see a huge correlation between asset size and the amount of borrowings that a CDFI has with the system. I mean, Capital Impact Partners is definitely not the largest in the top 10, and Community Investment Corporation is certainly not the smallest. So that is interesting when you consider that CDFIs, as we all know, come in different sizes and shapes, but there is no direct correlation. If you're a small CDFI and you find a benefit of leveraging your balance sheet through using home loan bank advances, all the power to you, versus if you're large and you prefer the grants, all the power to you there as well. Right now, Home Loan Bank of New York has a total of 20 CDFIs that is split between loan funds, credit unions, and CDFI banks. Federal Home Loan Bank of New York has 5 loan funds and 1 intermediary. Actually, this slide is actually no longer accurate because we are proud to announce that as of this morning, we just approved another CDFI loan fund member, Home Headquarters out of Syracuse, New York. So this is now actually 6 loan funds and 1 intermediary. Congratulations to Home Headquarters. We have 9 CDFI credit unions, 5 CDFI banks, and you will also see that the CDFI members span across the entire home loan bank district, New York State and New York City within the state, New Jersey, and Puerto Rico. Since first being granted access to the home loan bank system, non-depository CDFIs have gradually joined our cooperative since 2012, when Asian Americans for Equality became our first member. We've since admitted Community Development Trust, Inclusive, Corporation for Supportive Housing, Disability Fund, Community Loan Fund of the Capital Region, and as I just mentioned, our 7th member as of this morning, home headquarters out of Syracuse, New York. Home Loan Bank of New York has not only grown its non-depository CDFI membership base, we've also grown the scope of our CDFI business. On the bottom of the timeline, you'll see the various steps we've taken to integrate CDFIs into our cooperative. Some highlights of note are CDFIs were first able to pledge mortgage collateral very shortly after they joined the cooperative. We've granted access to our Home Buyer Dream program in summer of 2019, and most recently, our AHP program, which is popular among both member and non-member CDFIs, now provides enhanced scoring for member participation. And our Community Investment Officer, Dan Randall, will be sharing more on that later in the presentation. And finally, you'll see here a nice summary of the strong relationships that Home Loan Bank of New York has grown with CDFIs since 2011. Besides the growth in the advanced business, we have participated in the Home Loan Bank's systems CDFI working group, which several of our members have provided some excellent contributions to. We've provided extensive amount of disaster relief grants for the various hurricanes, earthquakes, pandemics that have affected our district, as well as partnered with many of the various regulatory agencies, trade groups, and other organizations within the industry, including CDFI Fund, SBA, Pepstone Enterprise Center, NeighborWorks, Enterprise Community Partners, ARIS, the New York State CDFI Coalition, and OFN. And we believe that the relationship between the Home Loan Bank of New York and CDFIs is very strong, and that it continues to grow and evolve each day, and we look forward to growing that relationship stronger and further. And now it is my honor and privilege to introduce to you our first speaker, Mr. Cliff Rosenthal, a man who I became familiar with when I first started covering CDFIs for the Home Loan Bank of New York. A brief rundown of his impressive bio. He is the former CEO of the National Federation of Community Development Credit Unions, now known as Inclusive, which was the 3rd CDFI member to join the Home Loan Bank of New York. Mr. Rosenthal drafted the New York State CDFI Fund legislation in 1984 and founded the New York State CDFI Coalition, an organization that we at the Home Loan Bank of New York are proud to support. Drafted first policy paper calling for a federal CDFI fund in 1986 and co-founded the National CDFI Coalition. Mr. Rosenthal started CDCU Mortgage Center, now known as Inclusive Mortgage, and served as assistant director at the Consumer Financial Protection Bureau from 2012 to 2014. A recipient of both a bachelor's and master's degree from Columbia University, Mr. Rosenthal is the founder of Archer Rosenthal Consulting and is also the author of Democratizing Finance, Origins of the Community Development Financial Institutions Movement. Cliff, it is an honor to have you here. Thank you for joining us today.
Thank you very much, Michael. I'd like to do a few things with the presentation today. First of all, give you a brief history of CDFIs, which some of you are familiar with. As you may have concluded from Michael's comments, I've been involved and engaged in this movement for a shocking long time. And I can tell you that this is the most exciting and promising time for CDFIs in my long career. Having taken you to the present, I'd like to give you an overview of the field today. In my book and elsewhere, I sort of make some distinctions. It's sometimes called a movement. I don't think CDFIs represent a single movement, and they're not exactly an industry either, though that phrase is often used. Let's just call CDFIs a field. Finally, I'd like to give you a sense of what the landscape looks like in terms of investing in CDFIs. What we have really seen is unprecedented in its scope and its depth, coming from multiple sources at this point. Next slide, please. So we talk about discoveries in this, what I call the year of CDFIs, which probably really runs from 2020 to 2021. I think that we can agree that the Black Lives Matter movement has brought unprecedented focus to something that students of the field have known for a very long time, namely the vast disparities and the racial gap, both in terms of wealth and income. So that discovery has become particularly obvious in the last year or two. But also what has been, quote, discovered has been the important and emerging role of CDFIs as lenders, especially to Black and minority businesses, which is seen as an important resource for addressing the wealth gap. The federal initiatives over the last year and a half have brought a great deal of attention to CDFIs, as I'll describe in more detail, through the variety of programs. And what has been really unprecedented is the advent of private capital, both from corporate philanthropy and from impact investment funds in the last couple of years. Next slide, please. So how did we get there? Next slide. I'm going to give you a very brief course. The first direct antecedents of what has become the CDFI field, I point to the Black churches, Black church credit unions and community-wide Black credit unions of the 1930s at the time, more or less corresponding to the emergence of the Federal Home Loan Bank System. Really, however, Black banks emerged even earlier in the 19th and even the 18th century. In the 1960s, we saw the unprecedented war on poverty, and poverty was sometimes called the rediscovery of poverty, and the, quote, the other America at that time. The modern roots of what became the CDFI movement really traced to the 1970s. South Shore Bank, sometimes known as Shore Bank, was the first real community development bank in the United States and sort of set the standard. My organization, the National Federation of Community Development Credit Unions, now known as Inclusive, was formed in 1974. You saw the earliest loan funds emerge, especially those under the auspices of the Institute for Community Economics, and really the predominant form of intervention of the federal government to rebuild communities in the 70s were the community development corporations, such as Bed-Stuy Restoration Corporation here in New York. During the 1980s, we saw the emergence of intermediary organizations, LISC and Enterprise, which of course have continued to play a major role. My old organization, the National Federation, we established a national intermediary, which we called the Capitalization Program, now called Inclusive Capital. During the 1980s, I was particularly involved in drafting legislation for the New York Corporation for Community Banking, which is the New York State CDFI program after all these many years. In 1985, the organization now known as OFN formed as the National Association of Community Development Loan Funds. In the late 1980s, I drafted a paper calling for what we then called the National Neighborhood Banking Corporation. And this became the genesis of the CDFI fund concept. Next slide, please. And please ignore the telephone. So the 1990s were the time when the CDFI fund was born. We, the Federation, OFN, Community Capital Bank, and Woodstock formed a national coalition. The exciting times start to come in 1992 when Bill Clinton was elected on specifically a platform calling for the creation of 100 community development banks and 100 micro-enterprise programs. So in 1993, July 15th, legislation was introduced. And by way of a quick plug here, if you do get my book, I hope you will read the chapter about how we, our motley army of emerging CDFIs, went to the White House Rose Garden in July 1993 for the announcement of this legislation, which took about 18 months to work its way through Congress and get passed. Finally, in 1996, the first CDFI fund awards were made. Next slide, please. 2000 was, as hopefully many of you will remember, a momentous decade. We saw a number of programs emerging under the auspices of the CDFI program, including the New Markets Tax Credit Program and the Native American CDFI program. The Great Recession was a major challenge to our young field. Most of our institutions did manage to survive, though there were challenges. We got a major boost under the Obama administration from 2009 on, which both boosted the annual appropriation of the CDFI fund, but also initiated programs such as the Community Development Capital Initiative under the TARP program, which in some ways is a forerunner of the Emergency Capital Investment Program that you'll hear about today. Healthy Food Financing Initiative made an impact, the CDFI program, and others as well. So over the course of 1996 to 2020, the CDFI fund has put out nearly $4 billion, mostly in grants in terms of the financial assistance program, and leveraged $61 billion in terms of the New Markets Tax Credit program, in addition to these other programs mentioned there. Next slide, please. So for the full detailed story, this is the book. I'll tell you at the end how to get a copy of it. It doesn't have a great deal of sex or violence, except for one rather shocking incident in the late 1980s that I will not disclose to this audience. There's your trigger warning, as well as some of the real high points. So going to the White House. Next slide, please. So where are we today? Just to review the basics. In the most generic term, CDFIs are specialized financial institutions serving economically distressed communities. Specifically, they are certified as CDFIs by part of the U.S. Treasury Department, and it includes multiple types of financial institutions which share this mission of serving economically distressed communities. Next slide, please. So what does this universe look like today? There are nearly 1,200 certified CDFIs. And what is striking is since Hurricane Maria, many Puerto Rican credit unions and cooperativas have become certified and received CDFI resources. Total assets of the field, somewhat impressive, 211 billion, though it does not rise to the level of one of the major banks. And here's a breakdown of the types of institutions that are CDFIs. The evolution that we've seen over the years is that loan funds, which used to be heavily predominant, still are about 50%, but the number of credit union CDFIs and bank CDFIs have grown significantly. Venture funds are not that numerous and have not been able to take advantage of it, quite to the same degree. Next slide, please. So what are some of the breakthroughs that have made this the year of CDFIs? First of all, it's federal investment in all its various forms. First, the Paycheck Protection Program, the COVID relief program, which is the $12 billion, the discovery of CDFIs by the private sector, and state programs as well. All of these are coming to fruition, and I'll describe them more in detail. Next slide, please. So the Paycheck Protection Program resulted in CDFIs being recognized as an important resource for loaning, especially to Black and minority and other small businesses. These are the numbers for participation by CDFIs, particularly. In 2020, more than 100,000 loans with an average loan size of 70,000, which went even lower in 2021. When preference was set aside in the early stages for CDFIs, and you see an average loan size of 43,000, which is quite significant when you consider that the program encountered some criticism because a great portion of the PPP money went to large borrowers from large institutions. And of course, the Federal Home Loan Bank has directed grants to CDFIs as well that also have targeted loans to small and minority businesses. Next slide, please. So this is the biggest and really unprecedented piece, the Emergency Capital Assistance Program. which will provide $9 billion specifically for minority depository institutions and CDFIs. What is striking to me is the unprecedented degree to which these federal initiatives have targeted smaller institutions. Will they go down quite granular enough? A little hard to say, because the great majority of CDFIs are very, very substantially below $2 billion in assets. And it provides support in a variety of ways: loans, grants, forbearance, and so forth. What is also, to me, unprecedented is the very targeted focus on promoting impactful and deep impact lending. And you see some of the areas of need that are specified specifically: low and moderate income areas, obviously, rural areas, which often have been perhaps underserved, urban areas, and so forth. Next slide, please. So in terms of the structure, these are not grant funds. These are long-term money. This is long-term money, which is a great thing, and in fact, structured perpetually for banks. They are low cost, obviously extremely important. But what is also innovative and extremely helpful is that the rate on these funds reduces if the recipients meet certain lending goals. As well, no dividends or interest for the first 24 months. So again, the key point is that this is equity in various forms. For banks, it's senior preferred stock. For credit unions, it's equity-like subordinated debt, which is a particular instrument that we at the National Federation helped invent in the late 1960s. So applications are coming up soon. Next slide, please. Now, the Emergency Capital Assistance Program Fund runs through Treasury. The $3 billion of the $12 billion runs through the CDFI Fund, which is the established and increasingly respected and supported channel for getting funds out to the mission-driven lenders. Of this $3 billion total, $1.25 billion is going out in also an unprecedented program, this rapid response program, which the innovation is that this is non-competitive. It's formula-driven, with a minimum of $200,000 per institution and a maximum of $5 million. Why I find this so helpful is that the smallest institutions that are often very limited in their ability to apply for funds have an excellent chance of getting significant capital, grant capital, to support their operations and lending. Another piece of this is emerging, the Emergency Support and Minority Lending Program, of $1.75 billion. And again, this is highly targeted for minority lending institutions, which I think is an important step, toward making a contribution to addressing the racial wealth gap. The annual appropriation, which has been the lifeblood for CDFIs for many years, the annual appropriation is $270 million, which is high. And there is talk that it may be possible to push it to as much as $1 billion a year if support continues in the future. Next slide, please. And for the private sector, again, this represents a magnitude and a kind of support which is unprecedented in my 3 or 4 decades in the movement. Netflix had made a $10 million deposit to Hope Credit Union, which is based in Jackson, Mississippi, but serves multiple states in the Southeast. A philanthropy initiative has blown a lot of people away. Ms. Mackenzie Scott, formerly associated with Amazon, as you know, has put out billions of dollars in unrestricted gifts. And among these are more than 30 CDFIs who've gotten infusions for their capital and their operating funds. Google has established a small business fund, and for that you should look to OFN. And we've seen impact investors that have prioritized CDFIs, such as the Olamina Fund in California, which specifically looks to target CDFIs that are managed and governed by Black and other minority leaders. Next slide, please. In New York, and this is particularly gratifying to me, as I mentioned earlier, back in 1984, I wrote a position paper calling for the establishment of such a program. It's taken many decades, but this year it is live. Over 5 years, it's $25 million, including $5 million per grant of grants available this year. And it's really unprecedented recognition of the support that New York State CDFIs have done. Again, this is grant money, requires matching from non-state sources, but that's coming online very shortly. Next slide, please. So what will all of this mean? It's almost an embarrassment of riches for a field that argued for years and for decades, really, to access capital in order to support mission. There's much of this is in the form of equity, particularly from the ECIP program and the CDFI fund programs, and also liquidity. It's going to undoubtedly mean stronger CDFI balance sheets, which in turn will enable greater leverage and bringing in more funds to CDFIs. It may give CDFIs the capacity to innovate more and try new products and new services that they've previously been constrained from entering into. Will there in fact be competition on the supply side? Will there be less demand for CRA deposits and loans and so forth? Will there be a race to provide who can provide the lowest cost money and the longest term money to CDFIs? Next slide, please. So some of this will be familiar to you, but let's review the credentials to get access to these funds. Above all, CDFI certification. This will give you access to the various CDFI fund programs, as well as the Emergency Capital Investment Program. There's the matter of low income designation, which does not come from the CDFI program, but this is something specific to credit unions, and it's available primarily through the National Credit Union Administration. Why is it important? Well, because it provides eligibility for equity-like subordinated debt or secondary capital for institutions serving low-income communities. This is a power that's not widely available to other types of credit unions. Finally, there's minority depository institution designation by the Treasury Department, which is required for access to the Emergency Capital Investment Program as well. And this designation is available both to banks and to credit unions. Sorry, it is not to non-regulated depositories. Next slide, please. So just to review very briefly something that may be familiar to all of you who are CDFI designated, but will have to enforce, in fact, reassert their mission and get recertified. You need to be a legal entity at the time of application, have a primary mission of community development, be a financing entity, serve one or more target markets, and the notion of target markets has expanded over the years. Particularly gratifying to many of us is that organizations serving people with disabilities has become one of the target markets, which was not one of the original targets. You must provide development services along with financing, maintain accountability, and be a non-governmental entity unless you are tribal government. Next slide, please. So again, if I haven't made the case already, why get certified? First, above all, the access to the large and growing array of CDFI programs, to the Emergency Capital Assistance Program of Treasury, the New York State CDFI program, which requires it, and for the Federal Home Loan Bank, access to liquidity and other programs, including their grant programs. So this indeed is the year of CDFIs. We hope it will continue in the future, but this has been an exciting time for all of us. Next slide, please. Finally, this is how you get in touch with me. In order to order my book, you can go to www.cliffrosenthal.com to find various channels for this. So thank you very much for the opportunity, and I hope this will indeed be an exciting year for all of you on the phone.
Wow, that was great. I want to thank you for the presentation. I was taking notes and I learned a lot from that. And I want to say to the audience, I really appreciate the opportunity to have this presentation today and talk with you all about the Federal Home Loan Bank of New York's products and our different programs. And I really respect the work that you all do. I looked at the list of attendees and I was laughing to myself because I follow some of you on Twitter. So it's exciting to speak to you all. Now, last year was a very tough year. We're coming out of a recession, and we all know that recessions have disparate impacts on underserved communities. And CDFIs are going to be so critical over the next few years because they really work on serving those underserved communities. And as we see the news coming out about the recovery efforts and how the economy is starting to come back, it's going to be important that CDFIs are a part of that process to make sure that these underserved communities and households are the ones that are going to be supported as well so that they can also recover. So I'm going to go to the slide. So what I do, and as Mike said before, I'm the bank's community investment officer. What my team does is we work on policy, strategy, and business development. But we really try to create and augment our products and our programs to support our members so that they can serve their communities. And I'm going to talk to you about 3 different types of products and programs that we have. They're in the form of grants and advances. And the first one is the Affordable Housing Program, where we provide up to $2.5 million of equity so that multifamily and single-family housing can be created. And can we go to the next slide? I'm also going to talk about our Homebuyer Dream Program, which is a set-aside program where we provide up to $10,000 to first-time home buyers so that they can purchase a home. And that is the way and the pathway for wealth creation is to get access to home ownership. So we'll talk about that program as well. And also talk about the Dividend program, which is our discounted advances that we provide to our members so that they can finance housing and economic development activities. But let's start off with the Affordable Housing Program. And on the next slide, what you're going to see is what I call the AHP Life Cycle. So there's going to be 4 areas in the AHP Life Cycle that we're going to talk about, and you can just jump to the next slide, Alyssa. Now, the Affordable Housing Program is a competitive program. And what I mean by that is that different developers and sponsors compete to get access to the Affordable Housing Program funds. So every year, we make about $30 to $50 million available for this competitive process. And we receive about 100 to 150 applications every year from developers within our district, but as well as across the country. And they are competing to get access to these funds up to the amount of $2.5 million, as I said before. But the only way to access these funds is through submitting an application to one of our member institutions. And what that does is allows our members to form business relationships with the nonprofit organizations and the developers that want to get access to these AHP funds. And typically what happens is a member, when they get an application from a developer to get access to the AHP program, they might even provide a loan on that project. Now, AHP dollars, they go to support the acquisition, the new construction, or the rehabilitation of a multifamily or single family project. And when we go through that process, there are several things that we look for during the application process. And that's what I want to talk to you about in terms of the AHP life cycle. So at the very top of this slide here, you'll see application processing, progress reporting, initial monitoring, and long-term monitoring. What that is each phase, so when we have the application process, we get 100 to 150 applications. The Federal Home Loan Bank staff will review those applications and then determine which ones are going to get an AHP commitment. And we look at those things by looking at the financial analysis and the sustainability of the applications. We also do a scoring review to see which projects score the highest. And we're also going to verify if they're eligible based off of our criteria. So once we've identified, say, the 40 to 50 projects that will receive an AHP commitment, then we go to progress reporting. And that project is now under construction. And they're going to need to draw down on their funds. And they can draw down on their AHP commitment by providing us with their drawdown request. And when we get that drawdown requisition, we'll review it, make sure that construction is going according to plan, and then we will release those funds to the developer of that project. Then we move to initial monitoring. And this might be about 3 years after the application processing. But initial monitoring is in days of the life cycle. Once the project is fully constructed and it's occupied, what we're going to ask for is for verification that the project has met all the criteria that we have. So we're going to ask for evidence that it's fully constructed. We're going to get a sample of the tenants to make sure that the tenants that are occupying that building are indeed low to moderate income households. And then in the last phase, which is long-term monitoring, we keep tabs on the progress of that project in terms of making sure that it stays compliant and it continues to serve individuals that are low to moderate income. So we just want to make sure that, 5-10 years from now, it hasn't turned into market rate units when you promised us that you were going to develop affordable housing. So what I just described there in that AHP life cycle spans about 20 years or so when you think of the application processing, progress reporting, initial monitoring, and long-term monitoring. But the good news is that the Federal Home Loan Bank staff is the one that does the majority of this work. So if members saying, well, it sounds like a program, the work is done by the Federal Home Loan Bank staff. We have a staff of over 25 individuals that are dedicated to these programs and monitors these programs, and we keep constant communication with the developers of these projects. So I'm going to ask if you can jump to the next slide, because I want to quickly identify something that Mike Byfield talked about earlier in this presentation. So we have a scoring framework here. There are 16 categories, and this is how we identify which projects are going to receive an AHP commitment based off of what they're going to do for the tenants in that building, as well as the other benefits that the project may present. So for instance, if the project is going to reserve units for individuals that are formerly homeless, they'll get a 6-point scoring boost. And if they're going to target individuals that are very low income, they'll get a 20-point scoring boost. So there's different incentives for things that we do. And the range of scores for projects that typically win an AHP commitment is between 80 to 65 points. Now, we had this category called member financial participation, which you'll see on the bottom right-hand side of this slide. And member financial participation gives the project 6 points if they get financing from the member institution. So again, here, this allows the members and the developers to form a business relationship. And because they're working directly with our members in terms of the financing, that increases the quality of the underwriting that goes into this project. So we're very excited to see that this scoring category is now in play. And we're looking forward to seeing very high quality applications that are financed by our member institutions in this upcoming round. The next thing I want to talk about is the Homebuyer Dream Program. So the Homebuyer Dream Program, the purpose of this is to support first-time home buyers. And we can go to the next slide because I want to talk about some key elements of this program. So once again, $10,000 is available to first-time home buyers so long as they're eligible. They have to be less of the median income. Most importantly, they have to go through home buyer counseling, which means that you have an educated home buyer that's going into this process. Then you have to make sure that the potential home buyer has identified a property that they're going to purchase. They also have to have skin in the game, which means $1,000 towards the purchase of that home. And our member institution is the one that will issue the mortgage to that household. Once those steps have taken place, the household has to sign a retention agreement which says that they're going to stay in the home for at least 5 years. So I want to jump to slide 41 just to talk really quickly about the process. And in terms of the process, there's really 5 steps here. So the first step is what we just covered, and that is that the member will identify that the household is indeed eligible. So they're going to verify that they're 80% or less of their median income and that they have skin in the game and that they have agreed to stay in the house for 5 years. Then there's the house reservation. You hit the space bar, you'll be able to go through to see what that looks like. And in that household reservation request, once the member has verified that the household is indeed qualified, then they would issue that reservation request to the Federal Home Loan Bank. The Federal Home Loan Bank will then review that reservation request, and the commitment will then be issued to the member institution, and that commitment is good for 120 days. Once the commitment has been issued, then the household will close on their house, and we can then fund the grant. And once that grant has been funded, we have the retention period, as I said before, and that means that the household should stay in that house for at least 5 years. And if they don't, then we would recapture a portion of those funds. So for instance, if the household was received $10,000 and they stayed in the house for only 1 year, then the majority of that $10,000 would have to be recaptured and returned to the member institution. But let's say the household received $10,000 and stayed in the house for 4.5 years, then a very small portion of those funds would have to be returned to the member institution. All right. So I want to jump real quickly, because we're running short on time. I want to jump quickly to our community lending programs. And on the next slide, what you'll see is that we have different types of community lending advances. And these advances are really designed for the economic benefits of underserved communities. So we have advances that are dedicated primarily for residential lending, but we also have advances that support economic development activities in rural areas and in urban areas. The key thing here is to recognize that this type of funding is there is at a discount, and we'll talk about the benefits of that discounted pricing in a moment. And the tenor of these advances is between 1 to 5 years. And on the next slide, what we'll do is I'll quickly define what economic development activities look like. So it's housing, which is the purchase, construction, rehabilitation, also pre-development financing for individual owner-occupied housing, as well as multifamily housing, as well as economic development activities, which are commercial and industrial activities in qualified areas. So it covers an array of different activities that you can do with this type of funding. And as I said before, it is discounted pricing. So for instance, on a 1-year advance, pricing may be as low as 25 basis points. So when you have 25 basis points to do economic development activities in underserved communities, it's a tremendous opportunity to do this kind of lending with cost of funds that are very competitive. But there's better news. So on the next slide, I wanted to talk about the dividend. So what you'll see here on this slide is that in the fourth quarter, our dividend was 5%. And if you go back 12 years, this covers about 12 years of dividend, you'll see the dividend has been pretty consistent, between 4 and 5%. Sometimes it spiked above 6%. And you see how well our dividends performed against the 3-month LIBOR and Fed funds. It is a reliable source of funding for our members in terms of additional cash that they can receive. But I want to quickly talk about the economic benefit of our dividend. So I shared before that for SECA advance, it's about 25 basis points for a 1-year advance. But when you factor in the dividend, which has an economic benefit of about 20 basis points, that 1-year advance at 25 basis points, the all-in cost is about 5 basis points. So at 5 basis points, in terms of the funding that you receive from us, you can support your communities in terms of affordable housing or economic development activities. And I understand that it's a low-rate environment, but still, 5 basis points to do that kind of lending is still an incredible feat. So really to the last slide here, thanks for your patience, everybody. This last slide, it has our president and CEO quote that I love. And when I read this quote, I think of the famous group of 1970s, the Jackson 5. and they had a song called I'll Be There. And Jose is pretty much saying that as well. Regardless of the situations, if you need a reliable source of funding, we will be there. So I'm going to stop here. I'm going to turn it back over to Michael Byfield. I would like to once again say thank you for everything you do for the group of CDFIs that are on this call, whether you're members or not members. If you're a member, please reach out to us. I have plenty more to say about these programs. We have small business recovery grants, and we're contemplating advances at 0%, and all these great things we're trying to do to make sure that underserved communities can be supported. And we want to have those discussions with you. So feel free to reach out to me if you want to have those discussions. And if you're not a member of the Home Loan Bank, then Mike Byfield and Goldstein, they would be glad to have a conversation with you all. But thank you all for your time, and I really appreciate all that you do. And Michael, I'll turn it back over to you.
Thank you so much, Dan. As always, it is a pleasure to have you speak and learn about the wonderful programs we have available at CDFIs. We do have time for a few quick questions. The first is, will the presentation be sent to participants? Yes, we are going to be emailing the slides and recording of the session. Just so you know, I do think that, you know, for I think all of us, that one point you might have heard it coming in and out. So if you did not get a chance to hear everything, or if you did not get a chance to write down everything you want, you can reach out to us personally, and we are happy to answer whatever questions or the issues that you wanted to bring up privately. One question that came in, and that is, what types of collateral does Home Loan Bank of New York accept for CDFIs? CDFIs can pledge first lien, single family, multifamily, residential mortgages, and first lien commercial real estate, as well as a variety of securities, including U.S. Treasuries, agency securities, private label, mortgage-backed securities, and even we accept home loan bank securities. We have another question. Is there a cost to join the Home Loan Bank of New York? There is no cost to join the Home Loan Bank of New York. You are required to purchase capital stock, like all members of the Home Loan Bank of New York, but as Dan just mentioned, the stock does not trade on the open market. It typically yields a generous dividend. Of course, we cannot guarantee that it will continue to do that, but history has proven it's a pretty reliable source. Unfortunately, we are getting short on time, but before we end today's webinar, we want to thank all of you for attending. We hope you found today's webinar informative and enjoyable. A very special thank you to our speakers, Clifford Rosenthal, once again, and Dan Randall. We thank Jody Harris and the other members of the CDFI Fund and the U.S. Treasury Department for joining us, as well as some of our other vendors and partners within the CDFI industry. And again, a recording of this webinar is going to be made available. So if you didn't get a chance to write everything down you wanted, or you missed something, please look for that and do not hesitate to reach out to us. Thank you again, and please stay safe and healthy.